Good morning, everyone. Here we are one more time, Marlene Gonzalez with Canvas Real Estate at the Miami Lakes office. Today, I'm honored to have Conrad Garcia from Equitable Advisors, who has gracefully decided to come in and share with us how we can make the best use of our commissions and planning for the future, right, Conrad?
That's exactly right.
Definitely, definitely. We can have a lot of closings, we can go on vacations, but the years pass, and sooner or later, we need to confront the fact that we need to have good financial planning from day one to make sure we invest our money properly. Conrad, tell me a little bit about yourself and how you got started in this industry.
Well, I'm a financial advisor and I'm with Equitable. I'm a local from here in Miami Lakes, born and raised. And I started with my company about 2 years ago, started building my practice. I got my undergraduate in finance and my master's in finance, and I decided to pursue a passion of helping people, informing people of their options, similar to the way you do business as real estate agents. So what I do as a financial advisor and a financial planner, I work with both businesses and individuals to help outline your goals and then create and implement plans to help you get there.
Perfect, perfect. So you're going to be sharing all this knowledge with us today. And of course, this class is being recorded and we will upload it by the end of the day to our YouTube channel, Canvas Real Estate Miami Lakes. If you haven't connected with us yet, please subscribe to our channel. So I'll leave the floor on to Conrad here.
Thank you very much. Today, I'm here as well with my partner, Alex.
Hey, good morning, everyone.
Morning, Alex.
Thank you.
We're going to be giving a presentation on how to maximize your business and how to run your practice like a CEO. Let me get a presentation up here. All right, can everyone see my screen?
Yes.
I just seen you.
Let's try this again.
Now, yes.
All right. Well, like I said, my name is Conrad Garcia, and we're also here with Alex Abinante, and I'm excited to share with all of you some ideas on how to make your practice more efficient. Our firm focuses on working with real estate agents and helping them automate their business and protect and grow their wealth. Now, I'm aware that there are agents that have been in the industry for a while, in addition to agents that are just getting started with their career, but I am confident that regardless of tenure, you will walk away with something valuable from this presentation. To those who are just starting, you are lucky to work with a firm that puts such high emphasis in growth and development. Canvas is one of the few that makes strides to implement health and financial wellness programs for their agents. So to start, what makes me qualified to present on this topic, you may ask? Well, like you, I run a practice that compensates me not on salary, but based on the work I do for my clients. Unlike W-2 employees, there are some specific planning areas that need to be addressed for 1099 individuals. I have faced many of the same decisions that you will have or already had to deal with. With that being said, the topic of conversation today is how to systemize your business like a CEO. Now, I've had the pleasure to work with and speak with hundreds of realtors and learn their best practices and successful habits.
I can take some. Oh, go ahead, sorry.
No. One major commonality between all of them is their passion to help and serve their clients, which often leads them to help and serve, working 10 hours a day and often 6 to 7 days a week without a break. Now, it's one of the reasons being in a service-based job is so rewarding. but it's often easy to get caught up in helping others and forget to make sure you take care of yourself, which can lead to financial stress, or worse, your exit out of the industry. Now, the goal of this presentation is to go over some of the fundamentals that would help automate key parts of your business to keep you organized and growing both professionally and personally so that you can do what you do best, which is helping your clients. Now, we will cover some ideas on how to be intentional and how to structure your business, manage your cash flow, budget, and track your progress and build your net worth. Now, business structure is an important decision as your practice matures from a professional standpoint and a financial and tax standpoint. The three major structures you hear about in the real estate world are sole proprietor, 1099, LLC, PA, and S Corp. Now, there isn't necessarily a best. It depends very much on the structure of your business, cash flows, tax liability, protection needs from liability. I want to cover this at a very high level and stress that you should consult with your CPA or legal professional on what is best for your business.
Yeah, let me move this around so everybody can see the screen. Okay, I don't mean to interrupt, but that way we can all see the screen as to what you're doing here. There you go.
All right, fantastic.
It took me a while to figure that out as well.
Independent contractors is the default option. In being the default option, it also makes it the lowest cost option, but it does pose some weaknesses as the business assets are not separated from personal assets. Agents will often opt to structure themselves as an LLC to create a separation from their business activities and their personal. There can be some additional tax benefits, especially for S Corps. I also find that people that structure as an LLC or S Corp take more intentional steps in their business planning and business decision. But that is just my opinion and certainly not fact.
But an agent, if I may interject here, because I'm in the same process myself. We, as an agent, can have a PA or an LLC. But we can definitely convert that into an S Corp. And I believe Iyala, who's on the call here in Zoom, did that. I haven't done it. Are you an S Corp? Yeah, I'm in the process of doing it, but I'm told that you have 3 years now to do an S Corp.
Yeah.
Do you want to weigh in on that, Alex?
Yeah, so just kind of diving into this, the pros and cons of either is more so based off of where you are with the business, right? So similar to what Conrad just said, the default option when you come into real estate, right, is you come in as a sole proprietor, your tax is a 1099. I want to make a very clear distinction here. Your business structure and the way you're taxed with the IRS are two very different things, right? So sole proprietor is just how you're viewed as far as business in the eyes of the state. 1099 is how you're taxed. S corporation, the only way for you to file as an S corporation is you have to have a more complex business structure, such as a LLC or a professional association or a PA. Oddly enough, I work with, just to introduce myself, my name is Alex Abinanti. I've been doing this for a long time. I work with probably 200 real estate agents across the Eastern Seacoast, all the way up from Maryland, Virginia, into the Carolinas, and obviously down into Florida. I've seen a lot of these different situations. As far as when does it make sense to file as an S corporation or have that more complex business structure, it tends to be when your commissions get to a certain level, right? So this is not something that you want to do right out the gate, because when you file as an S corporation, it's going to cost more, right? With more complexity, right? There's a higher degree of organization and filing requirements from your CPA. So you can almost automatically assume that your cost for filing is going to double. Additionally, when you file as an S corporation, another thing you need to keep in mind is, in addition to the actual filing, you have to keep some sort of books, right? Or keep payroll. This often means that you're setting up something with like a Paychex or ADP or maybe your accountant's able to do that. So there's a lot of different pieces to it. This is, I mean, the point in this slide is not for you to go to your accountant and say, hey, I'm going to go file as an S corporation, right? This is something where at some point, as you become more successful as a real estate agent, it will become a thought where, when does it make sense for me to start considering this? Okay. That sweet spot tends to be around the 100,000, 150,000 mark, right? But there are also a lot of different pieces to that that may make it worthwhile to do it at a lower commission level, or maybe make it worthwhile to do it at a higher commission level, right? A couple of things to keep in mind on that. And just because we're kind of already in the weeds here, I might as well just kind of finish my thought on this.
Yeah, oh, great.
The reason why we file for an S corp, or why we would file as an S corporation, really comes down to the concept of how you're taxed, and specifically your payroll tax, right? So in the state of Florida, we're fortunate enough that we don't have state income tax. It's a great benefit, right? But we are all still subject to federal income tax and this other thing called our FICA tax, which is our Social Security and Medicare tax. Okay. For those of you that may have been in the W-2 world before coming into real estate, or just in general, right? If we just look at the W-2 world, or corporate America, if you want to call it that, right? The payroll tax is split between the employer and the employee. Okay. That comes out to 6.2% for Social Security and 1.45% for Medicare. Okay. For the employer and the employee. As a sole proprietor or an LLC or a PA, right? Or just say a realtor in general, you are the owner and the employee of your own business. You bear the full formula, or the full tax, which comes out to 15.3%. Okay. The reason why people will decide to file as an S corporation is they can effectively split their income between earned income and unearned income in the form of what's called a K-1 distribution. Okay. Payroll tax, or that FICA tax, Social Security, Medicare tax, is only applicable to earned income, right? So the thought here is, if you're making $150,000, one idea would be take 75,000 as a W-2 comp in the form of the S corp filing, and have the rest of it pay out to you in the form of K-1. What we've effectively done is you're still getting taxed on federal income at 150,000, but only the 75,000 is applicable to that 15.3% payroll tax, because we were able to divide income with the S corporation. That, at a high level, is the thought process around it, right? If you think you're at that point, reach out to Conrad or myself offline, and we can actually kick the tires a little bit for you as far as, does it make sense to really explore that? Because there are some other cons to it also, right? There's things that we want to be cognizant of, specifically things around Social Security and how that calculates for Social Security benefit in the future. Okay. We'll just kind of leave it at that. If you want to click the next slide.
Okay, thank you for your insight.
So, Conrad, if it's all right, I'll just kind of roll through this.
Yeah.
So once again, the whole point in this conversation today is we're trying to be intentional with our business, right? So a lot of the things that we're going to talk about today, we already talked about the business structure, but also creating systems and automatizing your business so that you can mainly focus on your clients and not have to worry about these things in the background, right? Once again, if we look at corporate America, everybody in corporate America, they have all these systems already in place for them, right? They have their own insurances, right? There's already payroll in place, taxes being withheld, retirement contributions being taken out. Okay. As a self-employed business owner, you have to do all this on your own, right? It is a daunting concept, but once you kind of get it sorted out, right, and start putting those systems in place, it's much easier. And in fact, I would say it's even better from an opportunity standpoint. In the corporate world, you're limited to what you can do. As a self-employed business owner, you have a ton of flexibility as far as how you decide to grow your wealth, the different vehicles that you choose to use, and how you file, how you structure your business, right? It's a lot of options, but once you kind of narrow in and figure out what you're looking to do, right, it gets a lot easier. So first thing I want to talk about is, you want to make sure that we're stabilizing income in some way, right? And we're going to cover a couple different things here, right? First one is, you are your greatest asset, right? Your ability to be able to produce income or generate commissions, right, is ultimately what allows you to be able to pay your mortgage, pay your car, send your kids to college, save for retirement. Okay. Second thing we want to talk about, creating automated systems. Third thing, put yourself on a salary, right? Normalize comp, because we know in the real estate world, you may have a couple great months followed by a not so great month, right? Or you may have a great first quarter and a not so great rest of the year. And you don't want to find yourself in a position, 3 months into not having any commissions where you're forcing yourself out of the business because you didn't save money on the side. Okay. And then the last thing, from all of the real estate agents that I've worked with over the last 6 years, the biggest thing that I see and the biggest threat to real estate agents is not putting a plan in place to pay their taxes, right? Getting yourself in a tax spiral where you're consistently behind on taxes will force you out of the industry. And it doesn't need to be that difficult. There's some very easy things you can do to make sure that you have the money, right, to be able to pay your estimated taxes. So you're not finding yourself come April 15th, which, by the way, we're coming up on that date, scrambling to figure out, where do we pay our taxes? The penalties and fines are not worth it, and they compound quickly.
But how,
All right, so protect what you can't afford to lose. Did somebody have a question? Sorry.
questions
somebody-
will be at the end, or we can be doing questions while you're doing your presentation?
Up to you.
Go ahead and chime in so you don't forget any of your questions, Yala.
Yeah, what's
Yes.
your question?
No, my question is that I have heard about you, I have an S corp, and I would like to be on payroll, but should I calculate that payroll based on what I know that will be my net income? Because we have a lot of expenses as well.
Yeah, so it actually, it doesn't quite work that way. So the payroll component is you have to pay yourself a reasonable W-2 salary. That's comparable to, other professionals in the real estate industry, right? So the IRS being the IRS, they're incredibly vague as far as what you have to pay yourself from a W-2 standpoint. The rationale behind payroll is they want you to basically, if you're gonna have a $50,000 W-2, they want that money being distributed to you on a monthly basis or on some sort of frequency, and you having the taxes withheld for that, right? It's just a higher degree of intentionality with, when we're doing an S corporation. So I wouldn't even necessarily worry about net or gross. It's more so sitting down with your CPA and, first of all, finding an appropriate W-2 amount, and then figuring out how are you going to distribute that over the year as far as income goes.
Thank you.
And once again, I mean, it's a great question. And I can talk about, the S corp filing and the business structure, for an hour by itself. And it might be a good thing for us to just talk about offline, because it very much so is specific to your situation. What we talk about together is going to be drastically different than what I talk about with another agent, because there's just so many different dials and considerations when we talk about S corporations. And also, everybody has a different business, right? Everybody has different income expectations, family setup as far as total tax situation in their household, so on and so forth.
Okay, thank you.
Probably not the answer you're looking for. It might have been a cliche. It depends. But once again, touch base with us after this, and we can set up a
Yes,
time
I
to
will.
talk specifically on yours.
I will for sure.
Okay, great. So, protect what you can't afford to lose. I think it speaks for itself. You should have health insurance, right? It's great from a preventative standpoint, but also from a catastrophic standpoint. If something happens, you want to make sure that you have something in place where, if you get in a car accident, you break an arm or something like that, there's some way to subsidize whatever the cost is for the medical coverage, for the medical cost. Okay. So I think that speaks for itself. Couple pieces that don't necessarily come up readily in conversation. First one, disability. Right. I like to call real estate a full contact sport. Right. And what I mean by that is, if you're not out there engaging with people, showing people properties, being face to face with your potential clients, it gets to be increasingly hard to close business. I'm not saying it's impossible. I think COVID is a great example of how people did make the virtual world work. But I would say, and feel free to correct me if you think otherwise, but I imagine most of your clients like to be able to see the property face to face, engage with you face to face. If something happened where you were unable to function or perform the duties of your job, would you want to make sure you had some way to ensure that you have some sort of income, right? Ultimately, once again, if your commissions stop, your mortgage payment doesn't stop, your car payment doesn't stop, right? The cost for you to live doesn't stop, right? Is it important for you to ensure that? Second thing, life insurance, right? Especially if you have a family, right? You want to make sure that there's some plan in place in the event of an untimely death that they are taken care of, right? Life insurance is a great way to ensure that your loved ones are taken care of and that income can continue in the household. I'm not sure if we have any people over the age of 55 or 60 on this call, but long-term care is an interesting conversation. This is kind of like disability insurance for individuals that are in retirement, right? So long-term care is an increasing risk for those in retirement, and it's really insuring against the idea of having a event that you're in a nursing home, cognitively impaired, or otherwise needing skilled nursing or help to be able to live, right? And that's very expensive. Statistically speaking, I think it's about 7 in 10 people will have some sort of a long-term care event in their retirement years, and it's incredibly costly, right? So being able to put some sort of insurance in place is smart, or at least just making sure, does it make sense to put insurance in place, right? There's always a case for, self-insuring and retaining risk, but you want to look at all your options before you decide to go in any specific direction. All right, so automating your practice, right? And this kind of goes back to just being incredibly intentional, right? How do we run our practice like a CEO and not necessarily as just a realtor, right? Obviously, you are working in the real estate space, but you're also building a tangible business. You can scale that, right? So you got to start thinking like a business owner in addition to being an expert subject matter in real estate transactions. Okay. So first thing, how do we do that? Right? You should have a business operating account. If you haven't already done so, set up a business account, especially if you have a PA or an LLC, because there's no point of having either of those from a liability protection standpoint if your money's not flowing into a specific business account. This is what we call in our industry piercing the corporate veil, right? You can have an LLC and you can think that you're having the protections of an LLC, but if your money's commingled in your general checking account, it's not going to matter if something ever happened, right? I know nothing's going to happen to anybody on this call from a liability standpoint, but if it did, right, you want to make sure that you're doing it the right way, okay? Having a business reserve account, right? Once again, income is not necessarily predictable in the real estate world. Having some sort of reserve to be able to cover marketing expenses or other expenses is incredibly important, right? Just because you're not having transactions doesn't mean that you shouldn't be marketing yourself or attending events to generate and drum up new business, right? That would be the opposite way of thinking. Setting up a tax account, right? A separate account specifically for you to transfer a percentage of your commissions into on some sort of frequency. Maybe it's per transaction. Maybe you do it once a month, right? So that money's being set aside for taxes. And then from a personal standpoint, have your own personal emergency fund, right? Industry standard for if we were just looking out generally, people say it's about 3 to 6 months that you should have in expenses in an emergency fund. Because, once again, real estate is a variable comp space, you really should be towards that 6-month spectrum or on the 6-month end of the spectrum, right? And having a little bit more in your emergency fund. Don't find yourself in a tax spiral. I mean, I'm going to stress this like a million times. I've seen too many good agents, force themselves out of the business because they get caught up in this. Best practice, make 4 estimated tax payments quarterly, right? IRS wants you to make them quarterly. A lot of people like to make them at year end. It's not the end of the world. Just know that you're going to pay interest on top of that and penalties. The more money you make, the higher the penalties. Okay. Great little flow chart as far as putting yourself on a payroll. Right? I know I like to be able to see things visually. It helps me understand things better. If we look out on the left, right, we're just assuming, all right, we sold a house, we get our commission. Part of that money should go into a separate account for taxes. The rest of it goes into your business operating account. From there, right? And this is not a perfect science, right? You can kind of create this in your own way, but just giving you some sort of thoughts around this, right? Your business operating account can have a couple different segments where you have some money going into business reserves, you have some money specifically allocated for marketing expenses. I mean, how many people at the beginning of the year, part of their New Year's resolution, they say that they're going to put away XYZ for marketing? And how many people actually do that? Right? So how can we start being intentional and making sure that we are reinvesting in our business? And then the rest is paid to your personal checking, whether you want to call it a salary or whatever's left over as far as that commissions check. Right? Once again, this is not a perfect science, but it's a way for you to start thinking about this differently than maybe having everything just go right into one specific account. Right? And the whole idea, once again, is how can we be intentional, right? And start running this business like a CEO. Budgeting and tracking. I think it speaks for itself. You know, keeping a budget is a pretty sound financial practice. You know, understanding what is going in and what is going out on a monthly basis is important from a personal finance standpoint, but it's also important from a business standpoint and understanding, is the money that you're putting into your business creating a positive net rate of return, right? Is the marketing dollars that we're deploying actually getting us some sort of ROI, or do we need to actually look back and say, all right, maybe this isn't working. We need to try a different strategy. There's a lot of different tools out there, Betterment and Mint. I think one of them actually switched to a different name, so I have to update that. Those are two different softwares that you can use where you can plug in credit cards, bank accounts, other accounts, and it'll kind of give you a financial dashboard, right? Instead of maybe using an Excel sheet, you can kind of use some financial technology that'll help aggregate stuff for you and give you some reports.
Does something like QuickBooks is an option, or you feel these are better?
I believe so. Mint, I believe, is actually consolidated with QuickBooks now.
Oh.
So a lot of those, QuickBooks platforms, the financial organization platforms, they'll have these different apps or widgets built into them. There's not a better or worse by any means. I think it's, explore them all and see which one you like. The two on the left, AssetMap and eMoney, those are two financial planning softwares that Conrad and I use with our clients from a more high level planning perspective. I mean, these are things that we would aggregate information into when we talk about, setting up things like retirement accounts or transitioning a retirement account to a more complex retirement account, or even conversations linked to, what we were talking about earlier, the S corporation, and when does it make sense to start pursuing that? This is an example of the AssetMap planning software that we use. I think it's a great way for people to be able to see everything they have in one place, right? This is something we've been able to take people through and give them a good idea as far as a snapshot on their current financial picture. And what it allows us to do in the background is run some different algorithms where we can basically project, if you want to retire 15 years from now, right? You're saving 10,000 a year or 15,000 a year or whatever that number is, and maybe your spouse is saving 20,000, right? Are we on track or are we not on track to hit a specific goal? We could reverse engineer the same goal for something like retirement, or education planning, or even major purchase plans like buying a house or invest in real estate. Reinvesting in yourself, right? I think this is what we all strive to do, is to be able to grow our business, whether it's growing it from an income standpoint or, being able to grow it by bringing on other partners, right? In order to do that, you need to be able to have money on hand and be able to reinvest in yourself to do that, right? So obviously you want to be putting money away in retirement accounts, things like that, but we also want to make sure that we have cash on hand so that when the time's right or the right opportunity presents itself, you're able to kind of jump on that. I mean, how many times have you guys, ran into a house that, maybe for sale where you're thinking, wow, that'd be a great investment property for me to take on, right? In order to take on those types of endeavors, you got to have cash on hand to be able to make those capital investments. So investing for your future, as far as retirement goes, a couple of questions that we always get, what is the difference between Roth and pre-tax retirement? Which one's better? So first and foremost, Roth, when we save in a Roth capacity, Money goes in after tax, so we've already paid income taxes on it. It grows tax-free and it comes out tax-free when we draw on it in the future. When we save in a pre-tax capacity, the money is not taxed, it grows tax-free, and it comes out taxable at whatever our income bracket is at that point in the future. Okay. Which one is better? Yeah, I love giving this cliche response. It depends. Right. But I'll give you a couple thoughts on it. If you are new to real estate and you're making, let's say net income $40,000, but in 15 years or 20 years or towards your retirement years, you're going to be making 150,000 or 200,000. It probably makes sense to save in a Roth capacity. The idea is we want to pay taxes in a lower tax bracket today, let the money grow tax-free, and let it come out tax-free when we're in a higher tax bracket. Vice versa, right? If you are, fairly established, you've been in real estate for a while, you are in a higher tax bracket, and you expect your tax bracket to be lower when you're in retirement, saving pre-tax works out very well because, right, we're able to defer taxes today in a higher tax bracket, right, still get that tax-deferred growth, and then when we're in our retirement years making less income, we're drawing the money at a lower tax bracket, right? So there's no perfect answer. It's very situational, okay? One other thing I'll note, and this is incredibly impactful for real estate agents, pre-tax savings is a great way to reduce your tax liability, right? So it directly offsets your taxable income. So the example I have there is if you make $150,000, you put away $25,000 in, let's say, a SEP IRA, your adjusted gross income or your taxable base is $125,000. So in essence, we were able to shelter $25,000 from taxes. So we get a lot of agents around this time of year asking us, I'm getting crushed on taxes. How do I help that situation? Or how do I reduce my tax liability? This is a great way to do it. One note on that, we are in 2024. It's not too late to make a meaningful impact in 2023. As long as you haven't filed yet, you can retroactively make contributions to a retirement account. In fact, you can retroactively establish a retirement account if you don't already have one set up. And we'll talk about those retirement accounts here in a second. A good rule of thumb, you should have about 20% of your income going into savings with at least 10% of that going into retirement savings. That other 10%, you probably want going into your liquid investments, emergency funds, things like that. Not a perfect science. Once again, this is just kind of a blanket statement. Everybody has a different situation, so it may sway in one direction or another. But if you're trying to figure out, are you in a good spot with what you're currently doing? Make an attempt to have about 20% go to savings, of which at least 10% going towards retirement. Contribution limits. This is the 2024 numbers. I don't have the 2023 numbers, even though 2023 is still very relevant. Once again, if you haven't filed yet, you can still make the 2023 contributions. Okay. But these are the most typical retirement accounts that you're going to see for real estate agents. First and foremost, IRA or just a traditional IRA. I think most people are familiar with that. That's available to everybody, regardless if you're a real estate agent or not. The annual limit for that for 2024 is $6,500. Once over the age of 50, you have a catch-up contribution of $1,000 in there for a total of $7,500 if you're over the age of 50. Okay. The second on that list is what's called a SEP IRA or a Simplified Employee Pension Individual Retirement Account. This is the most common, if not the gold standard for real estate agents from a simplicity standpoint. If you're looking to set up a retirement account that you can put away substantial amounts of money in and not have a ton of overhead costs and organizational costs and things like that, SEP IRAs are incredibly easy to maintain and contribute to, okay? The way the contribution limits work, though, are a bit convoluted. All right, it's a two-part formula. So the max you can put into a SEP IRA in 2024 is $66,000 maximum, right? But you have to meet a criteria before you hit that $66,000, right? So it is the lesser of, it's 25% because you are self-employed and the owner of your business. It turns out to be 20%. There's a calculation that goes into that. So you really should use the 20% number. If you go on the IRS website, it's going to show 25%, but that's assuming you were an employee for somebody, not the owner of the company. Okay. Because you're the owner of your own company, it's 20%. So it's the lesser of 20% or $66,000 for 2024. So if you made $100,000, you could put away 20,000, and it's your net business income. It's not your gross. So it's income after expenses. Okay. That's impactful though, right? If we're able to shelter $20,000 from the 24% tax bracket, I think a lot of people want to try to do that. That's going to save them $5,000 in tax liability right there. Okay. Second one, solo 401k, right? So believe it or not, you can set up a 401k as a business owner, right? As a self-employed business owner, right? You don't need to necessarily have employees. You can set one up as a solo individual. Okay. They follow the same rules as any other 401k. The annual limit in there is once again still that 66,000 number. But because it's a 401k, there is a catch-up provision where you can put away an additional $7,500 if you're over the age of 50. Okay. When does it make sense to set up a 401k? If you have an S corporation, you should be looking at setting up a 401k. If you're going to step into a more complex business structure, oftentimes it makes sense to step into a more complex retirement structure because it's going to allow you to put away a lot more money. So when we talk about retirement contributions, you can only contribute to retirement through earned income, right? So if we look back at what we talked about earlier with the S corporation, the idea with the S corporation is to divide our total income between earned income and unearned income, right? To be able to save on the payroll tax, right? So if we're dealing with an individual that once again makes $150,000, they're used to putting away, call it $30,000 in their SEP IRA because it's that 20% number. But now they file as an S corporation and their W-2 is $75,000. Well, their SEP IRA contribution is based off of $75,000, not $150,000. So that's a problem, right? The way the solo 401k fixed that is with the solo 401k, there's two parts of the contribution. The first one is what's called the elective deferral or the employee annual deferral. And for this year, I think it's $23,500, something like that. It's $23,500 that you can contribute to the 401k regardless of income. As long as you made $23,500, you can contribute $23,500. It's not a percentage or some sort of a function of your net income. Okay. The second piece of solo 401k is what's called a profit share. A profit share is like layering on a SEP IRA to the 401k. Profit share allows you to put away an additional 25% of net business income as a 401k contribution. So collectively, between both of those, we can't exceed 66,000. Yep. So once again, if you have an S corporation and you're looking to make larger retirement contributions and you haven't looked at using a solo 401k strategy, we should have a conversation because simply making that switch will open up a lot more pre-tax deferrals that you otherwise were not able to do. Okay. And typically CPAs don't really talk about this, right? They're really good at managing what's going on in the current year. They're not so good at the forward-looking aspect of it. And that's okay, right? They can't do it all. That's where we kind of come in. All right. For individuals that are maxing out their solo 401k, their SEP IRA, and they're looking for additional deferral opportunities, there is another plan. They're called defined benefit plans. You don't hear about them a lot because the individuals that are contributing into them, they're probably doing at minimum $350,000, $400,000 in commissions every year, and they're looking to put in these plans at minimum about $100,000 plus. I manage a handful of them. The average contribution on a pre-tax basis into these is about $200,000 to $250,000 pre-tax contributions. It's a monster number, but with more complexity, there's a lot of additional costs and some other things in consideration. So it may sound good on paper. You got to really test it against your situation and see if it really makes sense for you or not. So I'm not advocating for you to do this, but if you find yourself in a position where you're maxing out all your other options, you haven't explored this, this might be something that we want to talk about. Non-retirement, right? I think retirement's great, but we want to make sure that we're maximizing other opportunities because ultimately retirement accounts are not very conducive for being able to buy houses invest in businesses, things like that, right? Because of the way they're taxed and the fact that you can't access the money until age 59 and a half without early distribution penalties, right? So we do want to be cognizant that we want money flowing into just general investment accounts. That might be investment real estate. That might be just investment accounts where we're investing in stocks, bonds, ETFs, or, alternatives. There's a lot of different areas in that. Overall, there's not one size fits all. I think this was really just to kind of get the gears turning as far as, is there things that maybe are worth adding to your overall picture? But if there's one takeaway from this, right, you don't need to put all this in place today, right? And I love this quote, right? Rome wasn't built in a day, but they were laying bricks every hour. You don't have to build everything today. Just take one step, right? Lay one brick. So if you don't have a plan in place for taxes, for example, and you're one of those individuals that start scrambling towards, March, trying to figure out how are we going to pay taxes for 2023, maybe that's that first brick that you need to lay to start getting yourself more organized and more intentional with your business. If you haven't done things for retirement, right, maybe we want to start looking at that as a first brick. What we don't have to do is try to reinvent your entire situation all today because we had this conversation. But at any rate, Conrad, do you have anything you want to add to that?
Alex, thank you for sharing your expertise. If there's one last thing that I could say, it doesn't matter if you just started off as a real estate agent or if you've been a real estate agent, for many years, there's something that you could do to get yourself, ready for the next step, for the next stage, to protect yourself, your home, your family, your business, to make sure that what you're doing is, actually working and that you're protected.
Okay, why don't we open the floor up to questions? Andrea, Irelis, do you have any questions that they can address? I know you could reach out to them afterward and schedule a one-on-one, obviously. Yala? Are you connected?
Yes, I'm here.
Okay, I know you weren't able to be here today, but I don't know if you have any questions off the top, or if not, you could discuss with them
Yes, I would like
after the class one-on-one.
Yes.
Andrea, I know you are at work, but thank you for connecting. Andrea just did her first closing. I'm not going to say the amount, but it was a very nice amount, a commercial transaction. So she wanted to make sure she was here. Yes, Andrea?
Yeah, hi everyone. I have a quick question. Obviously, like Marlene said, I did receive a substantial amount on commission, but although I have a business in place, I did not think to have that commission issued to that business. So with that said, I guess now I'm personally liable for the taxes. Right?
So that part doesn't really matter, right? So LLCs, sole proprietors, they're what's called pass-through entities. I mean, sole proprietor, it's just you, so it doesn't really matter. But pass-through means that all income flows to the owner in addition to expenses, right? The only way to avoid that would be setting up as a C corporation, which you absolutely would not want to do as a real estate agent. So it doesn't matter that it's not being paid to the business from a tax standpoint. What does matter, right, is if there was ever a legal claim against you with regard to your business, right, and you have everything as far as your business set up as an LLC and you operate as an LLC, because you have money flowing outside of the business and there's no real clear distinction between you and the business, theoretically, right, that lawyer can make a case for going after your personal assets, right? So that formal divide that you created by having an LLC will not benefit you, right? So once again, when we talk about sole proprietor, 1099, LLC, S corporation, a sole proprietor, an LLC, or a PA, that is how you're structured as a business. And depending on how you're structured, you can have a degree of separation. So when people set up as an LLC, right? They're an LLC because they want to create a separation between their personal assets and their business itself, right? And if there was ever an issue that happened, right? If there was a lawsuit, it would stop at the business. They're able to protect their personal situation by setting up as an LLC. S Corp 1099, that part doesn't really matter. The taxation, you're always going to get taxed. The reason why people set up that S Corp, once again, is you can be a little bit more cute as far as how you're classifying income. Hopefully, in a long-winded answer, that kind of answers your question.
Yes, thank you so much.
Yep.
Perfect. So, we'll go ahead and share your information
Great.
with, everyone here in attendance. And I'm sure if they have an interest, they'll reach out to do a one-on-one analysis. When Conrad was here at the office, he had shown a sample of what they put together. And it's like a roadmap, if you think of it, of how you're going to designate, you know, whether it's in savings, in stocks, bonds, retirement, 401k, so on and so forth. And that impressed me a lot. I'm sure we could share it with those that are here at the office. And then Andrea and Iala could schedule one-on-one, and you could show them the same thing you showed me. And that's what prompted me to have you come into the office today.
Yeah. Hey,
Okay.
you know, one thing I'll leave you with, feel free to ask us any questions. Regardless if it was something we covered today or not, chances are we've had the question before, and if we don't have an answer, we know the people as far as how to get you the answer.
I would like to add the following, that although this presentation was geared to us agents, that this is a great opportunity for us as agents to bring value to our customers, and having both of these gentlemen introduced to help our customers, you know, maximize their investment and their current incomes, because a lot of people out there, I would say, I'm gonna go on a limb, maybe less than 5% of people have a financial plan into the future. I don't know if my number is correct or not, but I'll put some money out there.
Yeah, and we've been able to help, you know, in some senses with the transactions, especially when, you know, we run into a scenario. We've had agents come up to us where, you know, the buyer's looking to come up with some more cash for a sale, or for a purchase, and they have significant securities that they don't want to sell because that they've appreciated certain levels. You know, there are some certain things that we can do on our end, whether it's securitized loans. I mean, this is not something that's specific to us, right? You know, the JP Morgans, Bank of Americas of the world, they do these things. So there are ways that we can help facilitate some transactions also if there is an issue where clients are trying to do something to come up with money. So,
and not only that, I'm gonna piggyback on that, on the sellers, that there are some sellers that they will have a tax liability if it's not their homestead property. But even if it's their homestead property, there's certain amounts that they could only cover or are protected on the homestead, I believe, if I'm not
250, 500.
250 if you're a single person. So a net of 300,000, you gotta pay 50,000 tax liability on that. And again, a couple 500,000, and with the values that are out there nowadays, you know, those could be hefty tax liability.
People are,
This is a great, two great gentlemen that I think that we could add to our team as affiliates that we could refer, so.
Definitely. And it's interesting you said the word seller, Joel. Andrea, remember your client sold a commercial property and is doing a 1031 exchange. Okay. And I'm not sure if he's lined up with financial planning of sorts, but you know, these two gentlemen could probably give him some insight as to what he should do to reinvest that money in terms of property later on, or if at the end of the day, he doesn't invest the total amount and he has to pay taxes on the difference, and is there a way to offset that? Have you worked with those scenarios before?
absolutely,
Alex and
yeah,
Conrad?
tax
For
harvesting
sure,
and
for sure.
trying to figure out where we can find losses in a given year to offset gains. The it's not a perfect strategy, right? Sometimes you're winning across all boards and you're gonna owe taxes, but sometimes owing taxes is a good thing at the same time, so.
One last point, the illustration that Marlene was referring to was actually an asset map. We had that up on the presentation and it shows your whole picture, your family, your business, every one of your accounts, your insurances, your properties, your mortgages. We outline your income, your expenses, so that you could see your current financial picture at any given point in time. No accounts get lost. We have your old 401k, we have your new 401k, all of your retirement accounts. We have your family, your kids, your assets, and then from there we create the targeted strategies, whether it's for retirement, if you needed a number, if you wanted to know the number that you needed to retire comfortably at a given income, an amount of insurance that you need to protect your life, your business, your income. What's the number that allows you to go out, visit your clients, drive on these Miami streets, as well be comfortable and secure that, if something out of the ordinary were to happen, your family and your business and your expenses are covered.
Definitely. So again, it's not only for us, it could also be like Joelle suggested for a potential client that is an investor, a developer. I know we're all working with those types of clients per se. Okay, great. Our time is up. Thank you for joining us once more. By the end of the day, we'll put this on our YouTube channel. And if you want to refresh, you'll be able to do so. And we'll send along the information of Alex and Conrad from Equitable Advisors so you can reach out to them personally. Okay?
Marlene,
So,
thank you.
Thank you.
by all means,
Thank you.
by all means, let me go ahead and stop the recording.